There is one number that separates the people who drown in debt from the people who get rich off it. It is not the size of the loan. It is not the interest rate. Two people can take out the exact same loan at the exact same rate on the exact same day, and one ends up buried while the other ends up richer than when they started. Right now, total U.S. household debt sits at $18.8 trillion, and the average American carries about $6,700 in credit card debt alone. For most people, debt is the enemy, but the wealthiest people in this country use the exact same tool to get richer. By the end of this video, you'll know the one number that makes the difference, and you'll be able to run it on your own situation tonight. I'm Ethan. Let's get into the 5 ways rich people actually use debt to make money. A loan is just rented money. You pay a fee, the interest, for the time you hold it. The only question that matters, does the money you borrowed earn more than the rent costs? That gap is called the spread. Multiply the spread by how many dollars you control for every dollar of your own, and you get the one number, your real return on your own cash. Number 1, trade credit, the float. Say you want to sell kitchen gadgets. The textbook version is you fly to a factory, pay cash for a container, ship it, then sell it. Your own money tied up for months. The rich version is different. A guy named Derek runs exactly this kind of import business. His suppliers in China don't make him pay up front. They give him net 30 or net 60 terms. He gets the product now and pays in 30 to 60 days. Derek sells the inventory before the bill is even due, pays the factory from his customers' money, and keeps the difference. His own cash in the deal? Zero. He's controlling an entire container of product with none of his own money. Leverage that isn't 5 to 1 or 10 to 1, it's infinite because you can't divide by zero. That's why selling is one of the most valuable skills on the planet. The seller never needed money, they needed terms. This one you can run today. A 0% intro card that floats your inventory, a supplier who gives you 30 days, a client deposit that funds the job before you spend a dime. Same mechanism, smaller scale. Number 2, real estate refinancing, BRRRR. This is where most finance channels get the math wrong. Sarah finds a rundown property for $500,000. She puts 20% down, $100,000, and takes a $400,000 mortgage. She spends $50,000 renovating it. Her own cash in the deal so far, $150,000. Once it's fixed up, the property appraises at $700,000. Sarah refinances at 80% of the new value, $560,000. She pays off the original $400,000 mortgage and walks away with $160,000 in cash. Here's what other channels get wrong. They'll tell you $160,000 minus $50,000 in renovation costs equals $110,000 profit. That's not what happened. Sarah put $150,000 of her own cash in. She just pulled $160,000 back out. She got every dollar back plus a little extra, and she still owns a $700,000 property with $140,000 in equity that she can rent out. Run the one number. Sarah's own cash left in the deal equals 0, an infinite return on her own money. Now the honest catch, because this is a numbers channel, not a hype channel. Sarah's new loan is bigger, $560,000 instead of $400,000, and at today's average 30-year mortgage rate of about 6.1%, that's a real monthly payment. Refinancing also costs another 2 to 5% in closing fees. This only works if the rent actually covers that bigger payment with room to spare. The refinance isn't the trick. Finding a property that genuinely cash flows after all of it, that's the hard part nobody sells you a course on. Number 3, buy, borrow, die. This is the strategy behind every headline about a billionaire paying almost nothing in income tax. It's not a loophole, it's 3 ordinary rules stacked together. Step 1, buy assets that appreciate: stocks, real estate, a business. Gains on paper aren't taxed. You only owe tax when you sell. So rule 1 is simple: don't sell. Step 2, borrow. Instead of selling and triggering a tax bill, you pledge your portfolio as collateral for a securities-backed line of credit, currently running around 5.5 to 6.5%. Your assets are growing around 7%. The loan against them costs around 6%. The spread is still positive, and you never sold a thing, which means you never paid the long-term capital gains rate, which climbs as high as 23.8% once you include the net investment income tax. Borrowing at 6% to avoid handing over 24% isn't just convenient, it's the entire point. Step 3. Die. Under current law, your heirs inherit your assets at a stepped-up basis. The gains you never paid tax on simply get erased. As of 2026, the federal estate tax exemption is $15 million per person, $30 million for a married couple. So for almost everyone using this strategy, even that final step is clean. The government estimates this provision alone costs roughly $41 billion a year in uncollected tax. Buy, never sell, borrow to live, die, and the gains vanish. That's the machine. This one isn't for you today. You need serious appreciated assets first, but the small version of this exact idea is coming up. Number 4. Hedge funds and short selling, borrowing in reverse. Instead of borrowing cash, you borrow a share of stock, sell it immediately, and hope the price falls. You buy it back cheaper, return the share, and pocket the difference. This is exactly how hedge funds tried to profit when they bet on GameStop in early 2021, and it backfired spectacularly. Retail traders piled into the stock, the price squeezed upward instead of falling, and short-selling hedge funds lost more than $13 billion. Here's why this strategy is dangerous in a way the others aren't. When you buy a stock, the worst case is it goes to zero. You lose what you put in, and that's the ceiling. When you short a stock, there is no ceiling. If the price keeps climbing, your losses keep climbing with no limit, and you still owe that share to whoever you borrowed it from. Same equation as everything else in this video, spread times leverage, but the spread can go infinitely negative. I'm showing you this one so you can recognize it and stay away from it. Number 5. Your credit score and the 0% arbitrage. The average FICO score in America is 714 as of early 2026. Every point above or below that number changes what your money costs for the rest of your life, on a mortgage, a car loan, a business line of credit. The rich don't have access to some secret bank. They have access to cheaper money because they made themselves cheap to lend to. Now the most accessible arbitrage in this entire video. Real 0% balance transfer offers right now run 18 to 21 months, sometimes longer, with a one-time fee of 3 to 5%. If you're carrying a balance at 24% interest, you are currently on the wrong side of the one number. You're the one paying rent at a terrible rate. Move that balance to a 0% card, pay the 3% fee, and you've just flipped a negative spread into a strongly positive one. That's not a theory. You can do that this week. Here's the whole video in one line. Debt is just rented money, and the only question that ever mattered is whether what you do with it earns more than the rent. The person who's drowning asks, how fast can I pay this off? The person getting rich asks, what's the spread and how many dollars can I control? Same loans, same rates, one number. If this changed how you look at the debt in your own life, that's the entire point of this channel. We post a new breakdown like this every other day, so hit subscribe if you want the next one delivered straight to you. Drop a comment and tell me which of these 5 surprised you the most. I read every one. I'm Ethan. See you in the next one.